Welcome back, everyone. So, if you've been paying any attention to your portfolio lately, you know that the stock market in 2026 is, well, it's feeling very different from the last few years. The rules of the game just seem to be shifting, and for a lot of focused investors out there, it's creating a real sense of anxiety. You might be wondering how to navigate this changing landscape without having to constantly monitor financial news or completely overhaul your strategy every few months. Well, in today's explainer, we're going to look at a brilliant data-backed strategy derived directly from recent market analysis to help you cut right through all that noise.
It really all boils down to this one incredibly powerful question. If you could only buy one exchange-traded fund, just one single asset to buy today and hold absolutely forever, what would it be? I mean, is there really a simple single asset solution to stock market anxiety?
Okay, let's dive into this. Here is our roadmap for today. We'll start by diagnosing the 2026 market shift, then unpack Vanguard's VTI. After that, we'll analyze its diversification and low costs, look at the magic of compounding, compare it against popular alternatives, and finally, we'll wrap up with the forever horizon.
All right, kicking things off with Section 1, the 2026 market shift.
Let's diagnose the exact problem a lot of portfolios are currently facing. From 2023 to 2025, the market was essentially a one-trick pony. Returns were heavily dominated by the Magnificent Seven and the broader tech sector. But looking at early 2026, the entire character of the market has changed. Tech momentum is cooling off, and we're seeing cyclical stocks outperform, along with a remarkably strong showing from small-cap companies, and even things like precious metals. What this means for you is, if your portfolio is purely mirroring the heavy hitters of the last 3 years, you are exposed to massive concentration risk. If tech leadership rotates away, which honestly it's already starting to do, highly concentrated investors are going to be left lagging. We need a way to capture the whole market's growth, regardless of which sector is taking the lead.
Moving right along to Section 2, understanding Vanguard's VTI. The solution to this concentration risk is our absolute hero for today, VTI, the Vanguard Total Stock Market ETF. Now, this isn't some flashy sector bet. It's not a high-conviction growth tilt that requires you to magically predict the future. VTI is essentially a complete ownership stake in the entire investable U.S. equity market. By tracking the CRSP U.S. Total Market Index, this single ticker symbol gives you exposure to large cap, mid cap, small cap, and even micro cap stocks. We are literally talking about holding more than 3,500 individual companies all at once, the whole shebang.
Now, what's really interesting about this breakdown is how perfectly the fund balances the market. Because VTI is market cap weighted, the biggest, most successful companies naturally take up a larger slice of the pie. The top 10 holdings make up roughly 34% of the assets. But check this out. A full 22% of the fund is dedicated entirely to mid and small cap stocks. This built-in diversification is the absolute core reason this strategy is working so beautifully in 2026. You get the stability of massive mega corporations, but you automatically include those smaller companies that are currently driving market breadth and showing all this new strength.
And hey, just to be totally clear, broad diversification doesn't mean you're missing out on the giants. Not at all. Your top holdings are still the titans of industry. You're holding NVIDIA, Apple, Microsoft, alongside Amazon, Alphabet, Broadcom, Meta, Tesla, and Micron. But instead of betting your entire financial future on just these tech leaders continuing their historic run forever, they are safely contextualized within the broader U.S. economy. Let's jump into Section 3, diversification and low costs. So what are the structural superpowers that make this ETF so, well, devastatingly effective? First, you've got to consider this number, 0.03%. Yes, you read that right. That is VTI's expense ratio. In the world of investing, you know you can't control what the market's going to return, but you have absolute total control over what you pay in fees. To put that abstract percentage into real-world, tangible terms for your wallet, you are paying just $3 a year to manage every $10,000 you invest. Think about that for a second. For less than the price of a single, frankly mediocre cup of coffee, you are buying a professionally structured index of over 3,500 companies. Most active funds, or even slightly more complex ETFs, charge substantially more than that. Over decades, avoiding those higher fees literally keeps thousands and sometimes hundreds of thousands of dollars right in your pocket to compound.
And the scale of this operation, it's almost hard to fathom. $2.3 trillion in assets under management. To put that into perspective, that is enough money to eclipse the entire GDP of many developed nations. It pays a modest but very reliable dividend yield hovering around 1%, which of course you can reinvest. It's got a proven track record dating all the way back to May 2001, and really importantly, it boasts an ultra-low portfolio turnover of just 2 to 3%. This low turnover means way fewer taxable events for you, making it incredibly tax efficient. Plus, because it's over 99% focused on the US market, you are dealing with very minimal currency risk.
This brings us to Section 4, the magic of compounding. So we have this perfectly diversified, incredibly cheap fund. How do we actually use it? Well, the real magic of a forever holding shows up when you combine it with consistent mechanical contributions. Let's just look at a conservative illustration here. If you set a monthly contribution of just $300 and earn an average annual return of 10%, which, by the way, is roughly in line with very long-term historical equity returns, and you simply reinvest and wait for 30 to 40 years, you are approaching a nest egg of $1 million or more. The only variables here are your discipline and low costs, and VTI gives you the absolute perfect vehicle for both.
So the crucial point here is that this strategy completely removes the emotional stress of trying to time the market. By investing that $300 every single month, regardless of what the scary news headlines say, you are dollar cost averaging. You mechanically buy more shares of VTI when the market drops, and fewer shares when the market is expensive. You aren't guessing, you aren't stressing, you're just executing.
Moving to Section 5, comparing ETF alternatives.
Now, I know what some of you are probably thinking. Okay, but what about the S&P 500? What about all those high-flying tech ETFs? Let's actually compare them. Take VOO, for example. That's Vanguard's massive S&P 500 ETF. It's a fantastic fund, same low fee, but it deliberately excludes small and mid-cap companies. If smaller stocks take the lead, exactly like we are seeing in 2026, VOO misses out. Then consider VUG for growth or VGT for pure tech. While they can have these explosive, amazing years, their concentration risk is incredibly high. If the tech sector falters, your whole portfolio plummets. And this brilliantly illustrates why VTI wins out. It's the only one here that captures the total market with low concentration risk while still keeping that vital 22% exposure to the mid and small cap engines of growth.
And finally, Section 6, the Forever Horizon.
Let's tie this all into the ultimate investing philosophy. Over a lifetime of investing, you are going to experience terrifying market events. History practically guarantees it. Since VTI's inception alone, we've weathered the dot-com bear market, the absolutely devastating 2008 global financial crisis, the unprecedented 2020 pandemic crash, and that brutal 2022 inflation sell-off. Through every single one of these catastrophic events, the total U.S. market declined, and then it recovered. It eventually pushed to new all-time highs. Patient owners of the total market were rewarded every single time. The key has always been time in the market, not timing the market.
From a completely practical standpoint in 2026, VTI really couldn't be easier to use. It trades just like a stock with massive liquidity. You can hold it in taxable accounts, IRAs, or your 401k. If you do want global exposure, it serves as the absolute perfect domestic core to pair with an international ETF. And honestly, the best part of all, the market itself does the heavy lifting for you. As the economy grows and companies innovate, VTI naturally allocates your capital to the winners without you having to lift a finger.
Which brings us to our final thought for today's explainer. With broad diversification, nearly zero fees, and total market exposure, set it and forget it actually becomes a realistic, highly effective strategy, rather than just some catchy marketing slogan. You don't need to be the highest returning investor every single year. Consistency and broad ownership are the true, reliable paths to financial security. So, as we look out at the changing landscape of 2026 and beyond, I'll leave you with this. If $3 and a little patience can buy you a stake in the entire U.S. economy, what's really holding you back from starting today? Thanks for joining me, and happy investing.